Well, hello again, Merle Dimbath, and it's been quite a week. Friday, the SpaceX finally had their IPO, and it was a grand event with billions of dollars or trillions of dollars raised, and the market reacted with a resounding approval. But the most important event for our wallets took place on Tuesday and Wednesday of this week when the FOMC met again for their every 7 week meeting. And this time we got a chance to see the new chairman in action. And it was a distinctive event because it was unlike we saw with Powell, where there was long statements and so forth, and a lot of discussion about the Fed still adhering to its dual mandate and so forth. Um, Chairman Warch's uh, statement was brief and to the point, and it's interesting to review just briefly here. We know that they held rates constant, and that was widely expected. It's what I expected them to do, and I wasn't alone in that. Most people were in that category, but there were pressures to either lower the rates or to raise the rates, and it might be helpful to maybe just review what some of those pressures are because they're not going away. They're going to be around into the foreseeable future, and it might indicate a future course. Um, as far as lowering the rates, of course, President Trump would very much like to see her lower rates, and that's probably a main reason why the Fed would not do that now, because that would smack of political issues, and the Fed values its independence and certainly doesn't want to go in that direction. But there would be other reasons to consider lower interest rates. One of them would be to help housing. A lot of people are still reluctant or unable to afford a house. Interest rates on the 30-year fixed are still running around 6.5%, and have been in that area for some time. And they of course track the 10-year bond, which is right around 4.5%. As I've indicated in previous programs, and as of course the press has revealed from time to time, the Fed did lower rates last September, October, November, a quarter point each time, for a total of 1 point. Now, what did they accomplish? Well, they did bring down short-term interest rates, which is not surprising because the federal funds rate is indeed a short-term rate. It's overnight. Um, but long-term rates today are higher than they were a year ago, and the yield curves show this very clearly. That the yield curve today is a little more of a traditional shape, with the lower end of the yield being at the short end of the curve, and the higher end of the yields being at the longer maturity of the curve, and that's the customary and traditional way we would expect a yield curve. But with long-term interest rates higher, of course, the 10-year is one of the longer rates, and it has maintained that position in the 4% range. And as long as it does, interest rates on the 30-year fixed are going to be in the 6% range, because there's that traditional a 2% margin between the 10-year bond and 30-year fixed, which is why the mortgage rate now is around 6.5%. Other reasons for lowering interest rates would be, of course, the National Debt Service. We're spending $1 trillion a year for interest on the national debt. Lower interest rates would help lower that, but that was not sufficient reason now to lower rates. Lower rates also might help certain businesses that are very dependent upon short-term financing, and so there would be these kinds of pressures to lower rates. At the other end, there's a lot of concern about raising rates, and in fact, I think 9 of the members of the committee indicated that they would be in favor of raising rates, not just holding them constant, but increasing rates. Why? Well, because of inflation fears. Now, yes, we've had the successful negotiations, hopefully successful, with Iran. Oil prices have been coming down. The curve of crude oil has been falling, and we've seen declines of the prices of gas at the pump. I've got some data on that I can show here, but Even though these forces have manifested themselves recently, the overall inflation rate has still been stubbornly high. It has been, um, and Warsh pointed this out, it's been over 5 years that we have had a interest rate, that we've had an inflation rate above 2%, which is the Fed's goal. And in fact, inflation this year is running around 4.3% and has been every month this year so far, right around that 4.2, 4.3% range. And as long as this continues, there's going to be people who will be very much concerned about inflation, rightfully so, because we've got a situation now of where if you look at the yield on a short term, say a 1 year bond, which would be in the high 3% range, and you compare that with the inflation rate over a year of 4.3%, the real cost of borrowing is actually negative from a what economists would call a real point of view. When the economists use that term, they're talking about an inflation adjusted point of view. So if you're if you were loaning out money and getting say 3.8%, 3.9% on your money, and if inflation is at 4.3%, you're actually getting paid back with dollars that buy less than the dollars could buy that you loaned out. And so this is not sustainable over a long period of time. Capital markets require real rates of return for stability and performance over a long period of time. So it's not surprising that we would see, as I recall, I think 9 members of the board are already in favor of raising rates. So this issue is not going to go away. We're going to see more about this in the months ahead. Now, what were the reasons offered by the new chairman for maintaining rates at their current level, which is 3.5 to 3.75%? It's a range for the federal funds. Well, the reason presented was that the economy is expanding and employment has been maintained and so forth. But if you get below the overall broad picture, there are some serious problems out there, and one of them is with younger workers. The overall national unemployment rate is around 4.3%, 4.2%. However, for young graduates from college, the unemployment rate is 5.6%, one of the highest we've ever seen for that particular demographic group. And if you're a young worker without a college degree, the unemployment rate is about over 7%, about 7.2%. These are very disturbing numbers because when young workers cannot enter their chosen careers in a timely fashion, they miss the opportunities for developing a skill and experience and contacts and a resume that will benefit them for future job opportunities. And these missed opportunities for employment at an early age have long-term negative effects on a young person's career. It's also disturbing to note that, as I recall the statistic, 40% of college graduates may be employed, but the 40% are underemployed. In other words, they're in jobs that don't require the degree. And that's unfortunate when you consider the thousands of dollars of debt some young graduates today have when they graduate from college. College is a very expensive 4 year period. And think long and hard about getting yourself in debt if you're a young person to go to college. There are many job opportunities that don't require a college degree. And it's not necessary that you get the college degree all at once. Maybe you'll have to spread that out over a period of time and not incur so much debt. You may have to pursue some type of a career or occupation that maybe is not your first choice, but nonetheless it pays well. And you may take a little bit longer to get that degree. But we definitely need to give more emphasis in this country to vocational and technical education. I don't know why we lost that focus because I remember when I was in high school, there were a number of vocational programs that my fellow students could take if they weren't interested in going to college, and many of them weren't, and so they pursued various types of mechanical and vocational programs that suited them very well, and they did very well with that. So uh, beneath the surface, we have some problems in our economy that need to be dealt with. And to be sure, the Fed can't solve all problems. I mean, they're in charge of looking after the banks and the money supply and looking after the financial system, and that's what they should be doing. And I have advocated before on this series of programs that I think we should do away with the dual mandate and just have the Fed concentrate on price stability and the money supply and the solvency of the banks and the proper functioning of the financial system. Um, uh, it's up to other forces to deal with the employment problems, such as the executive branch and the Congress. And to their credit, there have been some good bills passed in recent weeks and months to encourage production and return of manufacturing to the United States. And these are all positive in terms of the development of our economy. But from the point of view of our own investments and our personal financial situation, what can we expect from this new Fed? Well, it's quite clear that the chairman is not willing to just accept things as they are. He indicated that he has a definite commitment to solving the problem of the inflation and getting us back closer to that 2% range. He indicated that the past is not necessarily prologue when it comes to inflation, and that was good to hear. And he's appointed 5 different task forces to address a broad range of issues of how the Fed functions. And I was very happy to hear that he's concerned about the source of data and the reliable source of data and the concern of that data is always getting revised. And so he's wanting to examine that issue. And also he's concerned about the fact that the Fed has become a disturbing force in the economy because financial markets are always worried about what is the Fed going to do? Are they going to raise rates or lower rates? And we've seen time and again of where there can be a very favorable economic report, and you would think, well, gee, this is good news. But the markets interpret this as bad news because they're thinking, oh my gosh, what's the Fed going to do now? And Warsh very specifically addressed that it would be nice if the financial markets would react to the data and not react to how they think the Fed's going to react to the data. And I say amen to that. It's been unfortunate how good news becomes bad news just because of fear of what mischief the Fed may cause. Well, where do we go from here? Well, if you're in the market for a house, I would encourage you to do what you can to buy that house. Do not wait for mortgage rates to come down. They may come down eventually, but no time soon. Maybe you can work out some type of a lease option arrangement on a property where you could move in and pay rent, and maybe part of the rent could apply toward the down payment. Or negotiate with various lenders and see if you could work out some type of um, an alternate system where the interest rate is not fixed, but it's a what they call an ARM, adjustable rate mortgage, where you can go in now at a certain rate, say for for maybe 4 or 5 years, and then in that period of time, if rates fell, you would have the option at with a maybe small fee to adjust the rate. So um, uh, I'm not optimistic that you're going to see a 5% fixed rate mortgage anytime soon. It might happen within the next 5 years, but don't think it's going to happen in the next 5 months. So, in fact, if anything, we could be looking at higher interest rates before this year is out if certain members of the Fed get their way. And from an investment point of view, then what does that mean? Well, um, if you are a saver, higher interest rates will give you a greater reward on your savings. But if you buy bonds, just remember that when interest rates go up, the dollar market value of that bond goes down. If you pay $1,000 for the bond, and interest rates go up, well, that bond may drop down to the $900 range because there's an inverse relationship between the price of a bond and its yield. This has to do with the arithmetic of present value, that present values are reduced when interest rates are raised on an income stream projected out into the future. So just remember, there's an opposite relationship between interest rates and the dollar market value of a bond. Um, we may see new emphasis upon dividend type stocks, because if interest rates go up, then uh, investors may not be content just to wait for capital gains. They may go ahead and say, well, hey, if we can get a higher rate of return now on our money, we might want to consider that. So there's going to be some cross currents here in the financial markets from a financial and investment point of view. Uh, yes, it's going to be fun to follow stocks like SpaceX and Nvidia and so forth, and there will be these kinds of securities will, of course, attract a lot of attention and a lot of money, to be sure. But in terms of overall portfolio, it's best not to put all your eggs in one basket, as they say. It's good to have a diversified basket. And I think that will wrap us up for today. It's been an interesting week, a lot of different cross currents, and we'll keep looking at them, and we'll have future programs to comment on various aspects of that. So, best wishes, good investing, and see you next time. This is Merle Dimbath.